morning, everybody. We're a little bit late this morning because the headphones do not work. I hope you can hear me okay. We're going to try and charge those up a little bit, go live on Instagram here. There we are. We are live on IG, Facebook, LinkedIn, YouTube, X. We are good to go. Maybe in 3 or 4 minutes after some charging here, these headphones will start working for us. So welcome. We are episode 262 on a mid-August day, August 20th, 2024. Welcome to Mornings with Scott, the best damn business show for medium and small businesses on the planet. Did you see Lowe's today? Lowe's, the DIY and home improvement store, reported net sales down about 11%. We are in an economic decline. No one's buying houses. No one's selling houses. Therefore, no one's renovating houses. No one's doing the flip game because of the interest rates. Inflation is too high. There you go. Lowe's is down. I just noted that as I was logging on this morning. What was your favorite Kamala from yesterday? This should be a new segment on the show, right? Yesterday, I had mentioned that I had said that she had confused me with this idea of profit gauging rather than profit gouging. So much so that I was triggered into thinking that maybe I didn't know what this secret economic term is. But no, that was just her saying the wrong thing. And yesterday she was talking all over the place about ROI, but clearly didn't know what it meant. But that was not my favorite Kamala of the day. My Kamala of the day is she was speaking yesterday to a Pennsylvania-based high school football team where she told them that they are undefeated even if they don't win every game. By the way, her VP choice happens to be a high school football team, so a football coach in the past. So I don't know. That's just fun. Our theme today is not everything is smart, even though it may sound smart. We had a segment yesterday on from Naval, who I think unquestionably is probably one of the smarter guys in the world, certainly on X. And his thread of how to get rich without getting lucky. We had 3 excellent points on that yesterday, how to get rich. And we're going to do 3 more today, but I'm getting a little more skeptical. His first one is the first one for today is you're not going to get rich renting out your time. You will not get rich renting out your time. You must own equity, a piece of a business to gain your financial freedom. That was the first one from today. 4th one in the thread on X. And by the way, you can find him at Naval, Naval. So is this true? I think you're losing me on this one. To me, this is a definition game. What does rich mean? What is your definition of rich when you say how to get rich without getting lucky? Maybe Naval's definition of rich is different from the rest of us. The average pay of a Fortune 500 public company CEO is $15.7 million in 2024. You're pulling in $15.7 million a year for a while. You're probably pretty rich. Normal people might think. Now that includes stock compensation, which is sort of the equity that he's talking about, but not really. Those are just a form of skinning the cat, so to speak, creating salary. But even the base salary on average is $1.7 million. 1.7 USD per year as a base salary, an average compensation, a total of 15.7 million. And then what do? You're not spending that amount of money because you're working 24/7. So you take that and you invest it. That was his rule number 1, is you create wealth rather than pay and societal status. And so I think that one of the big lies for today's generations, the younger generations, I think in my day, it was absolutely true that you needed to own something like a business to create real wealth. Business, real estate, be in the financial industry. That's how you became real wealthy. But I think it's a lie. I think it's a lie to younger generations today. You can get rich by selling time. By your own definition of rich, whatever that might be, you probably can get rich by selling time in today's economy. Lots of people are doing it. Obviously, you're not going to do that in labor as an hourly rate. Although, I read some story the other day. We didn't talk about it last week. Might have been a good story to cover, of some guy who I think was in HVAC or plumbing or all of those. I don't remember. And I don't even remember what country he was in. He might have been in Australia, but he turned it into a subscription model. So people joined a membership. He sold memberships. He says he was shocked how popular it was. And, basically he was on call and prioritized those people. Maybe he came in and did some preemptive work and maintenance work for whatever it was under the subscription model. And he was bringing in $700,000 a year on top of his regular work just from the membership fees. I mean, there's a lot of ways that you can get rich in today's economy. The world is open to you. There's lots of abundance. I'm not really buying this one. Next point, you will get rich by giving society what it wants, but does not yet know how to get it. You will get rich by giving society what it wants, but does not yet know how to get at scale. Well, absolutely. I mean, this is the whole Silicon Valley model, isn't it? In your business, how does this apply to your business? Do you give society what it wants at scale? What it wants, and it doesn't yet know how to get it? Do you do that? Do you know your customers? Do you know your target market? Do you know how you differentiate from your competition? I absolutely believe in this one. And the third point for today is pick an industry where you can play long-term games with long-term people. Pick an industry where you can play long-term games with long-term people. I'm going to be honest with you, I'm not even sure what the hell that means. I don't know if that's awesome advice, but I'm guessing what it means is to build wealth over time, play the long game. Don't hang out with traders and people that are chasing the next bubble, like the Canadian cannabis LP game of however long ago that was, 5, 6, 7 years ago, where everybody was chasing that and getting rich quick in that bubble that lasted a few years. I don't buy this. If that is what this means, this being pick an industry where you can play long-term games with long-term people. I've spent a lot of time in my career with people that chase bubbles, trader. I mean, I work with troubled and distressed businesses. So obviously when the bubble bursts, you get a lot of that. A lot of people have got very wealthy from a trading mentality. It really depends on your personality, on your skill set as a business person, whether you're a sales and trading mindset or whether you are a slow, methodical, build tons of value over time sort of person, which I suspect that is who Naval is, and lots of other people are bubble chasers, and that works too. All right, you may notice that our theme today is that not everything that sounds smart is smart. And to that point, picked up a post on the website of Kearney, the consulting firm, and the article was on zombie M&A. Zombie M&A. So this is Kearney. Who is Kearney? Formerly known as A.T. Kearney, a global management consulting firm, provides services including strategy, operations, technology, and organizational transformation consulting. Operates globally in 40 countries. So it's a huge consulting firm. Think McKinsey. You guys have heard that name. Maybe you haven't heard Kearney. Personally, I can't think about the word Kearney without thinking about my very first awesome deal that I ever did. Was a mine site called Kearney that I bought, a distressed public company, bought the assets out of that. Did I buy the assets or did I buy the whole? No, I bought the public company itself. Anyways, it was a great trade. We don't have time right now. Maybe I'll tell you that story someday or later in this webcast live stream even. So their post on the website is called Strategic Investors Are Paying Premiums to Acquire Undead Companies, but the value they gain is short-lived. The zombie invasion continues. The number of corporate undead rose yet again in 2023, contributing to an increase that averaged 8.8% annually since 2010. Isn't that an awesome start to an article? And by awesome, I mean terrible. So first of all, what is the zombie? The zombie invasion continues. Isn't that such consultant speak? So what they mean by this, what is a zombie company? What they mean is it hasn't gone bankrupt. It's not dead, but it's sort of on its way. It's probably not making enough cash to pay its debt on a regular basis, which to meet its obligations on a regular basis, which in some jurisdictions is the literal legal definition of insolvency. And so that's what they mean by zombie. But in consultant speak, if you can brand a problem, if you can brand an opportunity or situation, you can productize it, and then you can become the expert in it. And that's what's going on here. Consultants, they drive me nuts with this sort of stuff. Zombies. It's not a distressed company like you and I might think about it. And I was sent at very late into. How you doing? I am Lonely Boy 100. Thanks for joining us on Instagram. I was like at midnight last night or 2 a.m. or something. I received an Instagram reel. Friends of mine send me reels all the time, and this one was of a consultant. That was the header on it, and dressed in, very slick looking guy dressed in black, and he's at a subway station, a couple of people standing around, and a train comes in, and it's got the brakes on it, slowing down, and the consultant jumps in just as the train is stopping and holds his hands up to the door. If you're on the audio, you're just missing an awesome impression of this reel. Holds his hands up to the door as if he's stopping the train manually, as the train is stopping by itself anyways. And then he stops, and then the train stops, and he steps back a little bit. People leave, people get on the train. Then he turns around and starts pushing it to get the train going again. And of course, the train takes off. And that is the definition of consulting. It just made me laugh because I think that is so accurate. And it also reminds me of the definition of investment banking, which is sort of what I grew up doing in corporate finance, which is, you just get in the way of something that's going to happen anyways. Well, so according to Kearney here, the number of zombie companies that don't produce enough profits from operations to meet their debt obligations, so there you go, there's the definition of a zombie, increased 7.4% last year. And the undead now account for 5.8% of all publicly traded businesses worldwide. Well, yeah, we've been talking about a bad economy and high interest rates and inflations for a long time. Obviously, the number of distressed businesses is going to increase. And by the way, more consulting, I want to say nonsense, is that I said at the beginning of this that all of their data is from 2023. And they posted this recently. So here we are in August 24. We get real economic data every day. Let me change the word real. We get fake economic data in an election year every single day, but it's in real time. Like, we get real current information all the time. Yet this consulting firm Kearney is publishing things from a study from 2023. What's more, investors continue to pay substantial premiums for zombies because in the first year after the deal, the undead companies generate double-digit shareholder returns that are comparably higher than those of the non-zombie counterparts. Wait, what? You can get a better margin buying troubled companies? Yeah, of course you can. We talk about that all the time. Question: how do they know that the acquirer is paying a premium for the target? What does that mean? Well, it means that the target stock price is way depressed and it's a stock deal, and they're measuring that they're paying a premium to market. Why? Because there is no market. Nobody's trading the stock because it's a zombie company. It's not a useful analysis. And I'll also remind you, a good opportunity to learn something here for us in our business, medium, small business. There are 2 types of purchasers when you're trying to sell your business. Or, by the way, you see my bottle of water here? My mother, who watches the show, thinks this is Red Bull. It is not Red Bull. I'm not here drinking a liter of Red Bull every morning to do this show for you. That is water with electrolytes in it. And it changed my life when I started doing that as a morning routine. So 2 types of purchasers, or if you're an investor in a business, it's important to know this as well. The first is a financial purchaser. A financial purchaser is someone who is looking for their return on investment from the target company specifically. Company A goes to buy company B, or financial investor A goes to buy company B, and that is their target. And company B is spitting out $1 million a year or $10 million a year in EBITDA. They have free cash flow in that range, and they do their valuation because the entire benefit to a financial purchaser is they hope that they can buy that cash flow a little cheaply, more cheap than it's worth, and then they can grow it a little bit just in the normal course, and they could sell it later. Maybe the multiple goes up, and that's what a financial purchaser is. A strategic purchaser is someone like, yeah, I want that cash flow, but also when I take company B and I merge it with company A, or I don't even have to literally merge it, I have some sort of relationship between them under common ownership, and all of a sudden there's a bunch of synergies. Like, think of companies that are in the same business but in a different market. Now I have better distribution reach, or think about, and also I can cut costs, right? I don't need two CFOs for two companies, like that sort of stuff. And so that's what a strategic is. And you think 1 + 1 = 3. And strategic purchasers will pay a strategic purchaser premium. They'll pay more than the cash flow is worth because they can benefit when they put this together. They're going to uniquely get a more cash flow and more value coming to them. So in the M&A world, that's the difference between a financial and strategic purchaser. And so when you're talking about distressed companies and companies paying a premium to the non-trading stock in most cases, which is what Kearney is talking about, they don't bother to tell you, or they don't seem to understand that distressed companies don't generate cash flow from a fair market value, by definition. From a fair market value perspective, there is no value, right? The value is to the strategic. Why would you buy, as a financial investor, why would you buy a troubled business that is not making cash flow and may never make cash flow unless you have some sort of strategic plan to turn that thing around and to benefit from it? So I think they're just making up words. I think when they're talking about a premium, they're talking about a stock, paying for stock above market price, which doesn't really matter and is not relevant to anybody's analysis, or is it useful? Anna, how are you? Thank you for joining in on Instagram, and Patrick as well. So then he goes on, but the Kearney firm here says, but in short order, the surplus value they create decreases to be more in line with that of other non-zombie companies. Is that useful information? Like, does that just mean that they overpaid? Hey, we got a short-term bump in our stock because we bought this other company, and then we learned that it's a zombie company. It's not doing great, and our stock just kind of goes back to where it is. That's what they're trying to say there. Look, you definitely make your money. I tell you this over and over. If you want to invest in distressed assets, make your money on the buy. That's where the chaos is. That's where the opportunity is. You can walk into a situation, you can make your money on the buy. You don't think, I see this so many times. We got this distressed situation, and if you did that, this, that, and the other thing, you can create value, recreate value to what it used to be, and then you can exit, and you can exit at this multiple. And therefore, I want to sell this distressed asset to you based on what you might be able to sell it to in the future. Not based on the value today, not based on the fact that if they don't find a buyer or a rescuer for this business, they're going to lay off all the people and they're going to go bankrupt. It's not based on that, right? It's based on what they think the thing is worth once it's fixed, even though it's not fixed, right? You make your money when you're investing in distressed assets on the buy. Always remember that. But in this situation with Kearney, when they say that things just kind of go back to where they were, when I say that's not useful information and it's not smart information, there's a million other variables that go on in a stock market. Why are you looking at stock prices before a deal, at a deal, and then later, a year later, whatever, after a deal, and saying, there was no accretive value on that thing? I feel like I had a point on that. I do. I'm going to save it. Well, no, I'll tell you right now. I was once speaking on a panel years ago, maybe, well, it was during the tech bubble for sure. It was in Toronto. There was maybe like 1,000 CFOs and, that type of crowd, legit business people working for large companies, maybe mid-market companies as well, but mostly in the tech space. And I ended up on a panel. It was a conference about valuation, investment banking, and trading. And I ended up on a panel, and there was a guy. There was 3 or 4 of us speaking, but the main people were me and a guy that was sitting beside me who was in the investment banking world. And I will not name him. I don't want to blow him out. I don't know if he's still around. He's actually a really decent dude. But this day, it worked out badly. So he was speaking right before me. And the entire point of his presentation is that mergers and acquisitions are never accretive. Just never accretive. They don't work. They do not create value. Any company that comes to this guy and to his investment bank for capital, and their business plan is roll-ups or working on M&A deals, he just got rid of them because that's not a way to build a business. That's not a way to build a business. And, that is wrong mathematically, because strategic purchasers, as I already explained, can benefit 1 + 1 = 3. That is creating value, I think, by definition. Mathematically, as I said, there's all sorts of examples of industries where there have been roll-ups, right? So it's a very fragmented industry, small businesses everywhere, and someone takes the initiative to buy one, find out a way to operate it profitably, buy number 2, find a way to merge that in, create some synergies, so you're a strategic purchaser, and then just keep going and create a big company out of a number of small companies, a big company that's sufficient. You see that all the time. That is creating value through M&A. Never forget, Elon Musk did not start Tesla. He bought Tesla. You can create value through M&A. There's no doubt about that. Now, this investment banker may have been statistically correct in the sense that, for the most part, we all screw up in M&A. We pay too much on the deal. We miss the due diligence. We fail to integrate one company into the other company. And so maybe statistically, that was the point. But I'm telling you, that was not the presentation. So unfortunately for this fellow, I was then the next speaker. And all I was doing was reading press releases. I literally just read press releases on a deal I had just done. So the deal was a public company. A public company was taken over by a small manufacturing firm. So it was a trading but orphan public company. It really had no operations left. And so there was an RTO, a reverse takeover. And what that means is you've got a public company with a bunch of public company shareholders and no real business, and then it buys a small manufacturing firm or two, which is what happened in this case. And the small manufacturing firm or two was worth like $1 million or a couple $1 million. I don't remember the numbers. I'm just making it up. But it's called a reverse takeover because public co is worth basically nothing. And so when it issues stock to buy the operating company, it has to issue so much stock that when they're put together, the operating company owners end up being the control block owners of the public company. Make sense? That's just value for value. And so they do this deal. It's a way for the operating company, the small manufacturing firm, to go public. I worked on this deal. I represented the public company. I wrote the fairness opinion, helped them structure some of this. And when they were done, excuse me, the stock was like 3 cents, which is what the stock was when they started, right? I mean, stocks never go below 3 cents for the most part when companies, because why bother selling? You're not going to get any money. It's going to cost you more in trading fees than to sell the stock. So the stock was like 3 cents. They do the roll in. The stock is 3 cents still. They do a reverse split, so they get less number of shares, and the stock is still 3 cents, 4 cents, 5 cents, somewhere in that range. And so I'm working in Switzerland, and I was living in Switzerland and working in Switzerland, and I come back on a trip to this town. I'm not even going to tell you the city and where it was in North America. And literally when I land at midnight after a month away or what have you, my cell phone rings, and it is a private client of mine in the wireless business. And his story is he's out of cash and he hasn't made payroll for months, 6 weeks, something like that. And just waited for me to come back. Wasn't doing anything about it. Waited for me to come back. Says, okay, what can we do? I need this amount of money. So I was like, wow, I've been away for a long time. So I'm not sure what we're going to do tonight at midnight when I'm exhausted, having flown back from Geneva. And so I went home. I said, we'll talk in the morning. I went home. I slept. I got up. I thought about it. And I said, I know what we'll do. It's wireless everywhere right now. You got to think back to the tech bubble. Wireless had a really big window, not a long window, just a huge bubble for a short period of time. Maybe that's a better word. And so I call up this public company that we just done the deal with shortly before that. And I told them the story, and we met at a lawyer's office at noon that day. And he bought the whole wireless company by 6 p.m. And the wireless company got enough money to make payroll and to have some working capital going forward. So we brought this wireless company into the public company. And based on that, the public company, because it was now in a hot space and it wasn't in a hot space before, was able to raise a bunch of money from the same investment bank that this investment banker on the panel was from. The exact same investment bank raised money from them. The investment bank got its big commission, and the stock popped to $8 based on the promise of this wireless technology. And the principal who started all this with the RTO into the public company, whose company was worth maybe $1 million or $2 million, as I said at the beginning, became worth about $100 million at one point. And liquid because it was so exciting in those days that the float of this public company stock, and float means, let's say you have 1,000 shares outstanding, but let's say 600 of them are held by closely held parties that are never going to sell or aren't allowed to sell because they have an escrow. Well, therefore you have 400 that are just in the quote unquote public's hand. And that's what they call the float. Well, at one point, for weeks on end, the entire float was trading 2-3 times a day. Like the volumes were insane. It was also back in the days of day trading, when that was really in a bubble as well. And so there was a lot of momentum. There was a lot of value created. And lest you think that value just burst, that bubble burst and went down to nothing, that is not what happened. What happened is the wireless bubble burst for sure. But this principle had created a bunch of value that was sustainable, not at the same level. And ultimately, much later, they made missteps and the company went back to being sort of defunct because they didn't reinvest that money at all. But point being, you can create value through M&A. So the rest of this Kearney article, because we're running out of time, is there's a bunch of zombie companies, and it's caused by interest, inflation, and yet the stock markets keep going up because it's scary that the rest of the world doesn't care. You know, stock market gains in the US are driven like by 4 or 5 companies. That's what the S&P is predominantly driven by. So the idea, as we talk about on this show all the time, that we are in an economic recession, no matter what people tell you, and we're in this economic recession, and that's going to hit medium and small businesses first. Well, that's exactly what this study is saying, and they pretend to be shocked by that. Yet, the winners in this environment are going to be the large companies, particularly when the government is handing out subsidies for everything. There's free cash everywhere. Who is that free cash going to? Is it going to you? If you're sitting in Columbus, Ohio right now, running a mid-market or small manufacturing business, are you getting checks? Are you getting checks? Anna, in your business in Calgary, are you getting checks from the Trudeau government? You're not. This money goes through the system and ends up in the hands of huge funds that support only the ultra large companies. And that's the way that works. So of course they're going to benefit. And of course their stocks are going to pop regardless of what is going on in the economic environment. The stock of Apple is to a large extent detached from the fate of the mom and pop business on Main Street. 100% detached. One has very little to do with the other, and this study just misses that entirely. I'm going to run out of time here because I spent too long distracted with my story that I like about creating value through M&A. But what I'll tell you this is, don't hire consulting firms for M&A. Just don't. You can do this yourself. You can talk to real M&A professionals. You can get great leadership, transitional leadership in the door. That's what I talk about all the time and offer as a service. You don't need a bunch of consultants making up stats that are a year and a half old and putting branding names like zombies around things and think that's adding value to you. It's not. It's trying to confuse you, and it's trying to sound smart when you really aren't very smart at all. All right, I think that's it. Any comments that I need to talk about today? We have a special guest joining tomorrow, and hopefully I will have my system fully charged so that I can have headphones so that the sound is better on this. I hope it wasn't too bad for you. Thank you, everybody, for listening. Hit like, hit subscribe, whatever platform you are on, and that would help out a lot. Show you support the show. Send us some comments. What else? That's it. Enjoy your day. Enjoy your Tuesday, and we will see you tomorrow, 8:30 a.m. Mountain. Hey, we have a special guest tomorrow. I just want to tease that. We have a special guest tomorrow in the finance industry who's going to tell us some legit things that are going on in private finance right now. See you tomorrow.